process. So thank you, Deanna.
Oh, it is my pleasure. I love working with you. You're awesome. All right, well, let's kick things off with questions. I do see Roland is here. Who wants to start off our questions? You just got to simply raise your hand and then we'll get those questions going. Good morning, Roland.
Hey, how are you?
Good, good, good. Oh, Menon, there you go. Look at that. Menon was not afraid to raise that hand. How are you today, Menon? It was good chatting with you the other day, by the way.
Thank you, thank you, thank you. Lovely to see you, Roland.
Hi, nice to
Um,
see you.
yeah, I have some logistical questions. And for example, like in your book, right, in your exit ready book that I read, you cite some examples, including the first example of this guy Mike who got a $15 million evaluation after consulting with you, and then you advised him not to sell, and then after 2 years, his value was like insanely 180 million or something. Um,
450 now.
450, yeah. Okay, good to know. So, is it possible for me to get some the actual example of the company name and all that for referring? No.
No,
Okay.
like too much of that is like I go as far as I possibly can to share everything, with you. But I know you saw the couple of posts in board. It's like I have to, go through. It takes me like an extra 30, 40 minutes just to censor out the stuff that I can't say. So and I have to be careful because it's, to the extent that things are public, I'm in the middle of a lot of things. And if somebody, hears strategy or what's going on, so I try to balance those two things. But yeah, I can't give you the specific ones there.
Got it. That's fine. The other question I have is similar to it. Like, how do I find out where your biggest partnerships or consulting opportunities or any collaboration with SaaS companies are? I know some examples that I've seen, but I'm basically pitching a SaaS company and I'm thinking of giving them some examples. It doesn't have to have details like reference details, but I saw that you have done some partnership with Microsoft. Is that like consulting partnership, or is it some sort of something else? Can you throw
It
some more
was
light
a
on that?
strategic partnership that we did. Gosh, that was a long time ago now, but yeah, it was a strategic partnership with their reseller network.
Okay, got it. And is there like any other SaaS collaborations that come out as something really standing out?
Why don't you send me kind of a description of what you ideally would like, and you can just like make it up but leave blank the references, and then let me see what I can do to help you fill those in.
Okay, cool. Thank you.
Hmm.
The last question I have is that you mentioned some consulting opportunities. I am looking at different areas, but if, let's say, somebody like me wants to get involved in those opportunities, is it more of the getting deals to you, or is there some other way that we
Yeah,
can
that's it.
get
It's
in?
like if you are out there, the I think I mentioned the six categories of businesses that I thought were really really significant opportunities. So those are ones that if you are out there and you find them and you want to do them together, then I am definitely open to that.
Okay, cool. Thank you. For
Yeah.
now, that's it.
Okay.
Thank you.
Yeah.
All right. I think Jeremy, I see you next. So Jeremy, how are you today?
Hey, Jeremy.
Doing well, thank you. Thanks, Roland. I have a quick question about how to think about valuations in the context of a market expansion.
Okay.
I have a SaaS business that is, we fit into the classic SaaS valuation aspect, but we want to.
You're a rule of 40.
Yeah, well, we're more than that. So we're
Nice.
we're we're
If
we're in
you're
the
a rule of
catbird seat
90,
as
then
far as
you're
that
like you're
goes.
a unicorn.
Well, we grew 80% year over year on 45% net margins, so we're doing
That'll
pretty good.
work. Nice.
Um, so we're looking at moving into a new market because we don't really love working with agencies, who's our current market. And part of that means that I have to bring less SaaS and more fulfillment, more kind of hands-on to the table because these guys don't have the hands-on capability.
Hmm.
My main question is around how does that impact my valuation? Because I do want to sell the company in the next couple of years. And what I want to avoid is putting too much service in it and taking out of the SaaS valuation category. So, the question is, do I do this new offering in the same company? Or do I set up a sister company that leverages some of the fulfillment as on a customer to customer basis with the SaaS company, which maintains the valuations of the SaaS company, and then it builds up a new, more of a services type valuation for the second company?
Yeah, I think it's a great question, and I like the idea of a separate services company that contracts for and licenses the software from the SaaS company much better than having them combined. You can have common ownership in a holdco, and then still preserve the ability to have them sold as a bundle or individually and valued individually or as a bundle. So I think that's definitely the way to do it. And then it just bolsters your SaaS company to have another licensee, especially if it's growing, right?
Right.
Yeah.
And do you see any concerns with almost like cross licensing? Because the SaaS stuff is obviously very much kind of done with you, in that the agencies have to do stuff. We are building a lot of heavy AI automation in this new offering to take it from done with you to done for you. So, and I know that a lot of these agencies will love to layer that on top, but the IP and everything for that would still belong in more of that services company. Could do a cross license with IP so that, to bring that in. Since it's AI, it still is automation, still doesn't take me out of the SaaS category. Do you see any concerns there, or anything that I should, be aware of?
No, I think you are I think you are on the right path.
Cool. All right. Thank you. Appreciate it.
Yep.
Thank you, Jeremy. All right, Chris, you're up, my dear. Chris, you're muted, honey. There you
Thank
go.
you. So just a little bit of a background, our business has been around for a little over 40 years, and we sell semi-trucks, trailers, and construction equipment. 2 years ago, we became an OEM dealership for a brand called XCMG. XCMG is the third largest construction machinery manufacturer in the world. It's been in North America for 30 years, but only in the United States for about 4. So they have an extensive line of construction equipment, actually more categories than any other manufacturer in the world. So we've had, we've been shouldering the burden of growing and building brand here in the state of Montana, and we see momentum continuing to pick up. However, growing a new brand, is also can be kind of expensive. So I've attended some of the meetings in the past where there's been some discussion around maybe capital partners that are good for doing acquisitions. I'm kind of I'm seeking, more cash and trying to figure out maybe the best way to approach or find the right type of, firm or company or investor to entertain, looking to help us grow this part, because we have so much growth in Montana. And right now, the ability to, the economy's been a little challenging. So to take equipment that is 30, 40, or 50% less in price compared to other big brands, but yet is as good, if not better quality, there's a real value proposition there for especially a lot of the smaller construction companies, but even the bigger ones. Bigger ones, it's a little bit more of a challenge because they might already have a gazillion dollars in cat parts on the shelf, so it's a harder switch. But for smaller companies, it's a faster switch. So I'm not a financial guru, and I'm not so I'm looking for ways to kind of look at this and or try to connect with an investor that might, be a good fit for a conversation.
Okay, so ask me that as a question.
Within our network here, do we have lending type of sources, funding, capital raise type of resources that I could try to connect with to explore some type of investment or partnership type of opportunity?
Yes, and that list is, so we have both kind of training on the fundraising, which Nate Dodson did, and we also have our list of strategic partners and things like that. So Bailey can give you links to that, or you can search for it in the portal.
Perfect. Thank you, Roland.
Yeah, perfect.
Thank you, Chris. All right. I think we have Chris Ambarian. Chris, how are you?
Hello, everybody.
Hey, Chris, what's happening?
how long you got? Um, I'll try and not answer that question and ask a different one.
All right, fair enough.
So much like Jeremy, we're a kind of SaaS and service company. And my ears kind of perked up there with you mentioning having like a holding company and splitting the SaaS and services parts.
Yep.
Could you give me a little more color commentary on the advantages of structuring it like that for both sides, and maybe some of the, the strategic implications or impacts of splitting them up? I know we can offer them both. Does it make it easier for someone to try and not buy both pieces when they become interested in it? And and at what point, sort of size-wise, does it make sense to break it into such a structure?
Yeah, those are all great questions. The advantage is this, the opposite side of the disadvantage coin, which is basically if you are operating at rule of 40 or rule of 90, and your services company, particularly as a startup, is going to be a drain and is going to perform less well than the SaaS does, which it almost always will, then it can break either of those things if you are meeting those. And so you really want to preserve those and work hard towards that. And if you're close to them or you're aspiring to get to them, then you don't want to do something that's going to make it even harder to get there. So the way that you can typically do that is by saying, well, look, the SaaS company is performing like this, but we do see an opportunity to enhance the services of the SaaS, maybe sell more SaaS, and we're going to do that through this services edition, which I think is great. But we don't want to adversely potentially impact how we value the other company. So then we do two companies, and then they've got separate financials. They're all under the same holdco. Holdco consolidates. If somebody comes along and wants to buy the whole thing, great. You'll probably hybridize the valuation and have a separate valuation for the services and the SaaS. It's easier and cleaner to do. You have separate financials, all that kind of stuff. So that's the big advantage to it. The disadvantage is, it's more expensive and, a little bit more work, but I think it's well worth it to do that. The other nice thing is that if somebody screws up on the services side, there's no liability for the SaaS side. In terms of when does it make sense to do it, the levels are typically, you're thinking $1 million, 10 million, and 100 million in ARR, in annual recurring revenue. So I would say, if you're not well above $1 million in ARR, it doesn't make any sense at all. If you're rule of 40ing or 90ing, and a lot of that is on growth, then I think you probably want to do it sooner rather than later. But I definitely wouldn't do it before I hit $1 million in ARR, and probably would be thinking more about being in the 5 range before I would do it.
Well, okay, so that's where we are. So, but strategically, I don't think that we fit your other criteria. So kind of the way things have unfolded, our market, our ICP, it's not really that SaaSable. It's more like a sale. I wouldn't even call it Salesforce model. Basically, the software is nice, but really what they need is people that understand their, what from their elbow, and can help them to use the software, bring their company into the software, or model their company in the software.
And where do you see the growth viability of the SaaS part?
It's hard to say. We have plenty of competitors in the space who've tried it and all failed because they don't have the service aspect.
Okay. Yeah. So maybe just have them together for now. Don't do anything yet. See how that goes. And if you see that the SaaS is going to hit that million, because your whole business is at 5 then, correct? Combined?
Over and headed toward 10. Yeah.
Yeah. Okay, great. But if the SaaS part of it would be, under $1 million in ARR, then to me, I'd wait till you get there. And if that part's not growing significantly fast to where you think that's going to be a giant part of it, or if it fails without the service because the service is not incidental to supporting, but is critical to, customer acquisition, right? Then that's going to ding the value of the SaaS company anyway. So there's not really any great advantage to having them separated.
Yeah. I have my doubts as to whether anybody can, come up with a software platform that is just going to just run on its own.
Yeah.
That's not the nature.
So then what you have is a tech-enabled service company, which is also great because it's going to get a bump in valuation for the tech enablement, right?
Okay, so yeah, that's where I see it. The problem that I see with that model is that it tends to muddy the numbers. On the services side, has an inherently lower margin, and having them all jumbled together means that neither of them is really cleanly metriced and
Well, if it's tech enabled, it's really not designed to be separated, and so you have a combined margin. So the cool thing is that the tech enablement is enhancing the margin of and making the company more valuable on the services side. So it's actually a good thing. It's really not a muddying. It's basically
Holy
just
cow.
let's just say that it was a muddying. Like let's take the worst
Yeah.
possible, right? Okay, it's all muddied. It's like, well, but our margin is still this. And because of the tech enablement, our margin is above industry average, right?
You just made my light bulb go off here. I mean, what if we managed it as a services company and looked at the tech as the upside? Holy crap.
Right. That's why you're here. This is good.
Wow, I got to go think about this.
Awesome.
Thank you.
Yeah, you're welcome. Let us know how it goes. Come back. Don't never show up again and talk about it. Tell us how it went.
No. We just joined a couple of clicks ago, so
Cool.
I'll be back.
Thank you, Chris. All right. Do we have any other questions? Oh, Sam, is that you? Or okay, nope, I don't see any other questions right now. Anybody else?
I'm gonna, if we don't, I'm just gonna take a second, since we have a little bit of time, just to share something with you guys. We're gonna talk about it on the Business Lunch podcast today, and if you're not listening to our Business Lunch podcast, I'd strongly recommend you do, because Ryan Dice and I talk about lots of fun things that will benefit you. But there was a article in Business Insider that was Jensen Huang, who is the CEO of NVIDIA, talking about the difference between task and purpose. And as you look at your companies, I think that the lens that he gave is pretty good, is that basically AI, there was a guy named, I think, Rincon, a few years back that said radiology is going to be obliterated by AI because the reading of charts is going to be completely AI-ified, and therefore he recommended against people pursuing careers in radiology. Radiology enrollments went down, but radiology is actually enjoying a boom. And the interesting thing is that, and this is what Wang was pointing out, is that really what Rincon was focused on was that AI is going to eat the jobs because it's going to replace the task, the people that are doing the task. But it ignored the fact that the purpose of radiology is to help people understand what's going on in that area of medicine and to diagnose and care for. And he then applied it to plumbing and HVAC and restaurants and things like that. And you can say, like, even if there is automated AI order taking and conversations around placing orders in a restaurant, and there's AI delivery of the food, or robotic delivery of the food, or automated delivery of the food, there's still the job for the waiter is the experience of being sure that the people are happy, engaged, taken care of. And AI, at least for the foreseeable future, and Elon Musk just said that with robotics, it's going to be a long time, he said, quote unquote, before it gets to the point where it's really what everybody is envisioning its ultimate ability to be. And that's for Musk, who built a AI center that they said would have taken most people, I think it was 19, he built it in like 18 months, and they said it would have taken 5 or 7 years for somebody else to do it. That's a pretty bold statement. So when you're looking at your company now, your software company, your HVAC company, whatever company, think about the race to zero is in tasks. And so if the company is an agency, like you said you were going to move away from agency, like you didn't like that agency model, I agree if the task is create content, right? But if the task is to analyze the content and create strategy and interpret the writing and then weave all of that together while interacting with the agencies and their clients and increasing the customer experience, then it's still a great business to be in. And so I think that as business owners fear that they're going to be eaten by AI and they panic to sell, valuations go down and opportunity goes up, not to acquire a sinking ship at the wrong time, but to realize the opportunity in all businesses, which is what we'll talk about today on Business Lunch, all the different categories, at least in my portfolio, all of the opportunities that there are then to take that task-oriented business and reframe it as the purpose, the thing that the people actually want, which it goes back to the, why do people buy a drill? They buy it to make, they don't buy it to buy a drill. They make it to buy it to make a hole. So if you're looking at your businesses through that purpose lens, that can be really cool, both in saving you from the AIification, of the business to where everything becomes a commodity and you're competing against AI, because you're not going to ultimately be able to compete against it better. But when you use it as a tool to help you, it's significantly different how you're looking at things. So I just put that out there for you when you're thinking about your acquisitions. When you're looking at valuation negotiation, I would be talking about how the business that you're buying is so dependent on tasks and AI is going to eat their lunch. And if with the current course, it's likely that the business is going to be worth significantly less in the future. And that's why they should sell it now. And that's why they should sell it at the valuation that you are proposing. If you are done with the acquisition, or as you are analyzing the potential for the acquisition, I would look and say, what's the risk? The threat of me buying this business is that there's a race to zero in perfect competition because it's all going to be eaten by AI anyway. And your job, like I'll give you an example, our tax prep business, tax prep is going to go away as something that humans do, but tax strategy is definitely got a lot longer lifespan. And I think there's going to be a big difficulty in replacing AI giving strategy, because AI just has so many limitations on what it is able to pull from contextually. And even if AI was going to completely replace tax strategy for us, it's still got to be informed. It's still got to be shaped and manipulated, and the right questions have to be asked. And it's just not there yet, and not likely to get there quickly. So if I'm buying tax practices now, which I am, that are tax prep businesses, then I'm buying them because of the tax strategy opportunities that are there, and I'm selling against the fact that they're going to experience basically complete obliteration of their existing business in just a few years, which they're all aware of. So have those conversations, like use that as you're analyzing, what do I want to buy? How do I want to negotiate? And what do I want to do to change this thing? Where do I see the pro forma opportunities for increased valuation, revenue, et cetera, in the future? That to me is a giant, giant, giant opportunity. So I will leave you with that unless somebody has questions about that. Haha, I got a question. Hey, Menon.
Hey, Roland. Yeah, I think what you said just now, that makes a lot of sense. Thank you for that. Yeah, by the way, I highly recommend the Business Lunch podcast. I'm like going back all the way and then going up, because I don't want to listen to the latest one. It's almost like I'm saving it.
I love
Is
it.
that good? Yeah.
I love
Yeah.
it. Well, thank you. I appreciate that.
Yeah. One question I have is that for companies of the size, like maybe 500K or to 1 million or something like that, when you raise the issue of professionalizing and as an exit ready, right, and it can bump it up by twice the multiple.
Yeah.
I think the first thing that they tend to say is, it's basically going to reduce my salary, right? It's going to cost them something to hire somebody while they are still owning the company. So how do you overcome that? I understand it, but how do you tackle that for?
I would just ask if they had ever made an investment before in their life. Tell me about some investments that you've made in the business or outside the business that have done well. This is an investment. This is a bet that you are making, informed by data, that if I spend X, I am likely to realize a benefit of Y or of X squared, right? And That's really, to me, the simple argument there. So it's like, if you think that you're going to be able to stay in this business and never make another investment, you're definitely going to experience complete stagnation, and possibly the business is going to go away in a few years. Just like you have to invest to replace equipment, you have to invest to replace models. And your model right now is a limiting model. So if I told you that you could buy another piece of equipment and it costs $1,000 and it was going to generate $3,000 in value, would you buy that piece of equipment? Well, yeah. Okay, great. I'm telling you right now, the equipment you need to buy is a change in your model. It's professionalization. It's an investment that you will make that has a data-backed return on the investment.
Perfect. All right. I don't know why I didn't think like that, but that's why I'm here.
That's why we're here. See, we can't
know.
replace us with AI yet. Yay.
Yeah. All right. Thank you. Thanks a lot,
Awesome.
Roland.
Cool. Well, thanks everybody. If there's no other questions, then we'll call it today and we'll see you next week.
Roland, I got a quick question.
Yes, sir.
In helping companies prepare to exit, where does this conversation enter and exit?
Which, give me just a little bit more than that.
Yeah, you had mentioned that you're doing the podcast with Ryan,
Mhm.
and you're saying, hey, these are the things that you're needing to prepare for the items in your business that are going away
Yep.
that AI can take. How would you have that conversation with a business owner who's preparing to exit?
I mean, I would, well, so it'd be very similar to the conversation I just had. It'd be, look, so we're talking about taking this thing to market. We're going to go through a process. We're going to be looked at by a whole lot of sophisticated buyers. Your current seller grade EBITDA is going to be radically adjusted to buyer grade EBITDA. Here are the things that they're going to look at, and they're all risk related. The single greatest risk that you have in your business right now is that AI is coming for the lower 30% to 70% of the work that you do. So a smart buyer, when they're buyer grading your EBITDA, is going to look at your EBITDA and discount all of the AI eaten stuff out of it and tell you, this is our adjusted pro forma EBITDA for you. And that's going to significantly adversely impact your valuation. Here's how we argue against that. We hit the ground running. We are proactive. We create the pro forma that shows that actually we recognize the task versus purpose difference. We are absolutely embracing the AIification of this lower level, because it's going to allow us to be more efficient and have a higher margin, because we don't need those people anymore, which allows us to reallocate our resources to the much more profitable, purpose-driven EBITDA. And that's why you want to pay a premium for our company, because everybody else 3 years from now who's buying these companies right now, Mr. Buyer, is going to be unhappy and you are going to be thrilled.
Perfect. Thank you so much, Roland.
Yep.
Awesome.
Looks like we got one more.
Yeah, Caleb, you'll be our last one. Yep.
Hey, Caleb.
Okay, I can stop. I mean, I'm jumping in late to the call. I thought this went until 12:30.
No, you're good.
Gosh, I
No,
hope
it
not,
goes
because
till
it's only
11, but-
9:05 here now. No, I'm
Yeah,
just kidding.
you're good. Caleb, go ahead. Go ahead and have your question.
What you got, Caleb?
Yeah, so we're in the middle of an acquisition. We're in the electrical services business. We're kind of working through a roll-up, and we're at the point where we've got an accepted LOI. We're completing our due diligence. I'm evaluating term sheets from lenders. So I'm at that stage now where I'm running out of any other future negotiation room that I want, and the deal looks pretty good. It's like a 4 multiple. It's a little more expensive than I like, but it's good enough for our solution, or for what we like. At this stage in the game, Roland, what are some of the things that you might do to optimize this stage of the process?
So I'm not so concerned. Like, if you've gone through the price and multiple arguments, then it comes down to structure. And so it's basically, how do you have an offer? And we're going through this with a service-based company that we're acquiring right now. And there's a competing offer from private equity. And the offer is basically 50% cash, and a 30% roll-in and 20% seller financing. And so how do we counter that? How do we negotiate that? To me, is how do I make the offer more certain for the buyer, for the seller, while still protecting the risk? And so one of the things, and it sounds more semantic when you say it than it is from a legal perspective, but one of the things would be, use the tools that allow them to know that the amount that they're selling for is going to happen. So an earnout is basically not a good way to do that, right? An earnout is, well, if you hit all these cool things, you got it. And if you don't, then you're screwed and you're not, and I get the, I got a deal, which is, a nice way of saying put your money where your mouth is. But when you start to think about things like detached warrants or roll-ins with buyouts that are triggered put options, that so basically you say, look, I want you to roll in this much into the roll up, but our value is that you're going to post close contribute, your thing that we're buying here is going to contribute to the overall value. And so when it does, you can have us buy you out for this amount. So that's a fixed obligation, not a maybe thing, right? The other thing that you can do is, so that'd be like detachable warrants and triggered put options. The other thing would be the difference between a CVR, a contingent value right, which is something that is theirs to lose as opposed to theirs to win. And that's the big distinction, is like, look, I'll pay you 4X for it, and 25% of that, or 1X basically, right, is going to be yours, as long as what you're telling me is true. And you're telling me that the customer is going to stay, the employee is going to stay, the key supplier is going to continue to do this, pricing is going to be this, margins are going to be that, whatever the things that are the risks that you're facing. And there can be multiple CVRs around that. We're frequently using 2 or 3 now. And the cool thing about that is it's like the difference is big. It's like these guys, and this is my conversation with this, these people that are selling this other company is you've got an offer that is kind of firm. It's kind of the 4X, but it's not really. Mine is 4X. And what I want you to understand is, as long as you can make me comfortable that the things that you're saying are going to happen, I'm absolutely going to pay it. I don't need you to do anything other than make these things be true. And the 2 best ways that I can do that are through RWI, which is reps and warranties insurance, which would be something that you would price into the deal. Like if there are reps and warranties that you're concerned about, make them buy insurance from their proceeds to cover the risks there. And then it's not their worry, because if those things turn out not to be true, then it's covered, you get paid, your risk is gone, and they've paid for it for pennies on the dollar. So win-win, right? And if they really believe that those things aren't going to happen, they should be pretty comfortable with that. And then the second way is the CVR, to say, as long as these things continue to be true that you have said are true, then you've already earned this, and it's only going to be clawed back in the event that the things that you said didn't stay true. So that's really getting into the, like the Q of E analysis and that kind of stuff.
So this is going to be, it's not going to hit that level of Q of E. I mean, it's a $3 million acquisition, 2.9.
Well, you can run an informal Q of E, right? You still have the ability to do that because it's all risk-based.
Right. And we are doing that internally, but we're not running through an accountant side. And it's SBA backed. So, right. So, the limitations of that, but I can buy insurance for employee departure or customer departure.
To cover reps and warranties. So how that prices out and what specifically they'll give you is, a moving target, but I would look into those things.
Okay. I'll ask our broker about that. That's cool. Because that is the risk area, as you know, with service business. Are the customers going to stick, and are the employees going to stick? Yeah,
but particularly framing those as CVRs as opposed to earnouts, it is a big difference. Because what you're saying then is just like, look, all I need is you wouldn't want to sell me a business that wasn't worth, wasn't worth what you said it was, because things that you said were going to stay didn't stay, right? That is to me so much better than tying it to like profits or something, or even revenue.
Well, you can't really in the SBA world, right? So what is this term again? CVR?
Yeah, contingent value right.
Contingent value rights. Okay.
And I've talked a lot about it on LinkedIn and Instagram and X. If you just look in my my social on it, and I think we did a podcast episode on it as well.
Fantastic. Well, that was worth the price of the call. Thank you.
Yay! Sadly, the call was free.
Can I ask a follow-up question on that, Roland?
Say again.
Can I ask a follow-up question on that?
Sure.
So we'll be, again, we have the services component. I'm curious as to, like, a lot of those things that you described seemed like asymmetric from the standpoint of the seller and the buyer. And I was just wondering if there's another mechanism where you basically your objectives are aligned completely.
How would, if you had to say that they were not asymmetric and that they were aligned, how would you say what I just said could be aligned?
Well, some sort of there was the in this case for multiple guarantee.
Yep.
But is there a sort of a timeline for sticking around? Is there I'm just wondering if there is a buyer controls the board, but both participate upside or downside until the board takes an action.
That's effectively what the CVR does. So I'm negotiating with you and say, Chris, I get it, man. I see the 4 absolutely as it sits and stands here today. It makes sense to me. I say, let's go forward with it. There are things that I'm going to have to do. Like if I was just doing this as a straight deal, I wouldn't be able to get you there, but I'm really excited because I've got a way for us to work together, to collaborate, to get you this number that you want. It looks like this. Here are some tools that we've been able to use to help sellers get what they want. It's all about me. I'm aligned, because I want you to get your number. I'm okay with it as long as these things remain true.
Right.
And so we've got this amazing, wonderful set of tools now that helps us get there together to your price. So it's asymmetric in that I'm afraid of the risk and you want the money, but it is aligned and symmetric into I want to get you the money because I want to buy your company. I want to get you a fair price. I need to be sure that the price is fair. Here's how we make sure that happens.
Got it.
Does that make sense?
Yeah, I'm gonna bone up on this then.
I love it.
Thank you.
Nice. Awesome. Well, that was a great way to close things out. I like that. Dee, anything else to say before we hop off?
I think we're good. Thank you, everyone. These were great questions. We really appreciate you showing up today. Thank
Thanks,
you.